Hey everyone, welcome back to our channel. If you're new here, don't forget to hit that subscribe button so you can stay updated with all things finance. Today, we're diving into a fascinating topic that affects your money, your investments, and ultimately, your financial future. We're going to explore the difference between active and passive investing. So, whether you're a seasoned investor or just starting out, stick around because this is something you won't want to miss. Now, here's a question for you. Have you ever wondered whether you should be actively managing your investments or taking a more hands-off approach? Let's break it down. First, let's define what we mean by active investing. Active investing is all about strategy, research, and a hands-on approach. Investors who choose this style believe that they can outperform the market by frequently buying and selling stocks based on market conditions, economic indicators, and company performance. For example, consider a mutual fund manager who actively manages a portfolio of stocks. They might analyze quarterly earnings reports, follow market trends, and react to news events to make investment decisions. The goal? To beat the market average, often represented by a benchmark index like the S&P 500. According to a study by Spiver, which tracks the performance of actively managed funds, about 82% of domestic equity funds underperformed their benchmarks over a 15-year period. That's a significant number. Many active investors face challenges such as high fees, which can eat into profits, and the difficulty of consistently making the right trades. Speaking of fees, active investing often comes with higher expense ratios due to management fees, trading costs, and other operational expenses. This is crucial to consider, as higher fees can diminish your overall returns over time. Now, let's talk about passive investing. Passive investing is often likened to a buy-and-hold strategy. Instead of trying to outperform the market, passive investors aim to replicate the performance of a specific index. This is typically achieved through index funds or exchange-traded funds, or ETFs. Imagine you invest in an S&P 500 index fund. Instead of trying to pick individual stocks, you're effectively investing in all 500 companies in that index. The idea here is that, over the long term, the market tends to rise, and you can benefit from this overall growth. According to research from Vanguard, over a 10-year period, 93% of actively managed U.S. equity funds lagged their benchmarks. This statistic reinforces the idea that, for many investors, a passive strategy might be the way to go. One of the biggest advantages of passive investing is the lower costs. Because these funds have lower turnover, they generally come with lower fees. This can lead to significantly higher returns over the long term, especially when compounded. Let's look at an example. If you invested $10,000 in an S&P 500 index fund with an average annual return of 7% over 30 years, you'd end up with about $76,000. If you had invested the same amount in an actively managed fund with an average fee of 1.5% and a lower return of 6%, you'd only end up with about $57,000. That's a big difference, almost $19,000. Both strategies have their pros and cons, and the right choice often depends on your individual financial goals, risk tolerance, and investment timeline. In summary, active investing aims to outperform the market through frequent trading and research, often incurring higher fees. On the other hand, passive investing focuses on matching market returns with a more hands-off approach and lower costs. The key takeaway? Understanding your investment style and preferences is crucial in deciding which path to take. If you found this video helpful, please give it a thumbs up and share it with your friends who might be on their investment journey. Also, let us know in the comments, are you team active or team passive? We'd love to hear your thoughts. And remember, whatever strategy you choose, always do your research and invest wisely. Until next time, happy investing!